Lance Roberts returns.
Merry Christmas to you too, you little freak.
Yeah, I know you know that I know that you know that I.
That's one of my daily opportunities that I have to spend some quality time with myself.
Starting Monday, January 7th at 6 a.m. on AM 700, the voice of Texas.
Yeah, we're excited about getting back to doing a morning radio show, 6 a.m. in the morning, 700 a.m. Of course, we'll be broadcasting that live at our internet site as well, realinvestmentadvice.com. You'll also be able to pick it up through RIA Pro, RIA Advisors. I mean, basically all of our websites. You'll be able to get access to the radio show, download it, podcast it, you name it. But we always have a lot of fun because it's a live radio show, so there's always a lot of cutting up going on. So generally at 7 in the morning, we're generally caffeined up and groggy at the same time. So you never know what's going to happen. Anyway, hey, Mike, welcome back to the show. So one of the interesting things coming up is Jerome Powell. Now, he's going to be speaking here in the course on the 18th and 19th of the month, talking about Fed rate hikes, what kind of the dot plot is, going into 2019. Of course, it's highly expected that he's going to hike rates one more time in December. But in the last couple of months, he's now changed his language from, well, we're nowhere close to the neutral rate to where we're now very close to the neutral rate, which is basically equivalent to saying that economic growth is catching up with interest rates rather than interest rates catching up with the rate of economic growth. In other words, slower economic growth expected next year, probably somewhere around 2.5%, maybe. And that's curtailing the Fed from being able to hike rates too much from here without potentially a recessionary impact. The issue becomes, this is what's expected. What if Jerome Powell comes out and says, we still think the economy's okay and can withstand higher rates, and we're still going to hike a couple more times next year?
So that's Jerome's tone has changed based on one speech that he gave a week ago. Mm-hmm.
And the perception has anyway.
The perception has. And everyone is basing, including ourselves, basing a new outlook based on what he said. Now, prior to that, a lot of people, ourselves included, and Daniel DiMartino Booth, who you've had on the show numerous times, mm-hmm. have held Powell out as different from Bernanke, different from Yellen, different from even Greenspan, in that he is not as interested in saving the market. He's not as interested in, he does not like QE. So we were kind of holding out some hope. The speech last week changed perceptions a little, that he quickly, over less than 2 months, his tone changed drastically. So is he seeing something that's very different from what we're seeing going forward? Or is he acquiescing to the president's threats or concerned about the stock market? And on Wednesday, I have a piece that looks at those three and discusses it slightly.
Yeah, and I think it's very interesting because, one thing that Danielle DiMartino Booth has said and others is that Jerome Powell is very different, and he doesn't care about the stock market. That he's really focused on, making sure Fed policy matches what's going on economically. But if he has changed his tone, then a 10% decline in the market very well may have shown that he's much more market sensitive than what people thought he would be.
That's right. But again, this is all based on one speech.
Right.
And he has an opportunity either at the Fed meeting on the 18th or 19th, or when he'll speak after that, which shouldn't be too long after that, to correct the market if he wants to.
Right. Well, and again, it's what's interesting here is from that point is that, he can certainly come in and correct any misunderstanding that he might have made. Or that might have been taken out of his recent speech. But, one thing we have to remember is let's go back to 2010, 2011, when Ben Bernanke launched QE the second time. He said very specifically in a statement that the focus of QE was to create the wealth effect. And the wealth effect was going to help provide for economic growth because people would feel better. They go spend more money because they had higher asset values, et cetera. So even Ben Bernanke admitted that the market was very important to the overall action by the Federal Reserve. And, of course, we've got a president currently that has staked his entire presidency to whether the market is moving up and down as confirmation of whether or not he's doing a good job, which I said from day one was a very dangerous thing to do when you're a decade into a bull market.
Right, but let's also let's tell the listeners what the wealth effect really is. It is to pump stocks higher so that the investors that own stocks and make a lot of money then go out and spend the money. And it's a version of the whole trickle down economics where the rich get richer and then they spend the money and everyone gets richer. Unfortunately, that's not how it works
well,
in the real world.
Exactly. Well, I interviewed Peter Atwater today. We're going to have that interview here on Wednesday or Thursday of this week. But one of the things that he specifically said, of course, he's a behavioralist, and one of the things that he specifically addressed too is that one of the things you're seeing in France currently with what's happening with the Yellow Vest riots there, you're seeing a lot of the populist movement here in the U.S., is that the Federal Reserve has created a wealth gap, not a wealth effect, and a large chunk of the population has not participated in the benefits from the market rally. It's all primarily centered at the top of the ladder, which those individuals don't affect overall economic growth that much. You increase the wealth of somebody that's already wealthy, they don't go and spend more money. They keep spending about the same thing they were already spending before. They just have more in savings.
That's right. It's a very flawed policy, but it's one that ever since Greenspan, the Fed has believed exists, even though it doesn't. And there's enough evidence to show that it doesn't work. But that and other Fed policies, such as 2% inflation, leads to income inequality, wealth inequality, and we've seen it in this country with Trump being elected. We saw it with Brexit. We've seen it throughout the world, and we're seeing it in France right now. That more and more people, a broader bunch of the population, not just the poor, but the middle class, are being negatively affected by the Federal Reserve and other central bank policies that are all very similar.
Absolutely. Speaking of Brexit, I mean, this was one of those issues that was supposed to devastate the world when it was originally done. And that's why in March of 2016, that's why, Janet Yellen called the ECB and the Bank of England, and everybody jumped in with, central bank quantitative easing from overseas, because it was to forestall the impact of Brexit. Yet what's happening now with Theresa May and Brexit, I mean, it looks like we're on the brink of a very violent disruption of this whole Brexit issue. What do you think the impact of the market is from that?
I think the market's very much underestimating what could come out of that, because Europe is in no condition to bargain with England right now, because they have enough problems of their own. Look at Italy, look at France. And if they give England a sweetheart deal, or said differently, if they do not punish England severely for leaving, these other countries are going to start talking about it. I mean, look at France. The word Frexit is coming up now. I mean, these countries are going to start saying, you know what, let's negotiate a deal. Let's get out of this.
Well, this is one of my big issues with the whole European Union concept to start with, Mike, which is, the one advantage that the U.S. has is that we can print our own currency. So if we need to pay off debt or something like that, we can print our own currency, and then we can do what we're going to do from there. Once these people all join the monetary union, they all gave up that ability to print their own currency. So you almost have to expect at some point that France and Italy and these deeply indebted countries at some point are not going to want to comply with the austerity measures that are ultimately going to have to come from the ECB and the EU, and they're going to want to depart so they can go back to printing their own currency.
Right. And the other problem is, as history has shown, is that France can go to war with Italy and Spain and all these countries, but Maryland can't go to war with Texas. It's a very
you'd lose.
We'd get our asses kicked. But that's a different story.
Well, the only problem with France going to war with Italy,
it's a very different union.
Yeah,
it's a very different union, and it's one that some of the economic, there is a lot of benefits to the euro, but there's also a lot of problems with the euro and the way it's constructed, and the way that it has largely benefited Germany.
Right.
Has benefited other countries, but it's more fake than lasting.
Right.
And we're starting to see the whole union fraying because of the construct.
Well, and again, the different, the United States, if people, just in case people don't understand this, the United States is a monetary union. we have 50 states that have all agreed to operate under a single currency, a central bank, and a government, right? And we have a constitution that ties all that together and lays out constructs for how money is supposed to work and how the economy works, et cetera. The problem with the EU is they said, okay, let's become the United States. Let's all come together, free trade across state lines. It's going to be great. But they never put in the documentation to make sure that they never put in that monetary contract. And, now here it is years later, everybody's still trying to sort of do their own thing, which doesn't work. And, again, the debt remains the biggest issue. And of course, the canary in the coal mine for the entire European Union is Deutsche Bank at this point. And I think there's way too little attention being paid to Deutsche Bank.
I agree. And Deutsche Bank is a German bank, and it's going to have to be bailed out. It's going to be bailed out by the European Union. And the same time they're going to bail out a German bank, they're trying to tell Italy no to a budget deficit of 3%.
Right.
And they're going to have the same issue with France, because France is now increasing wages and decreasing taxes. They're going to have a bigger deficit. So this is going to be harder and harder for Germany to steer. Germany is sort of a leader of the European Union, and this is going to be getting harder and harder for them to steer this ship.
So closing thoughts here. Think we're going to get a rally through the rest of the week, or what's your bet? If you're a trading man and betting on a rally, what do you think?
If I was a betting man, which I am, I would probably bet on a rally for the next week or so, but I would put a very tight stop on it.
Yep. And
stop loss.
And we will be talking about what we do for our portfolios at rapro.com, as well as on our website through Technically Speaking. So if you grab our Technically Speaking post tomorrow or any of our comments later on this week, you'll find out what we're doing with our money as well. So follow us there at realinvestmentadvice.com and our YouTube channel, of course, The Lance Roberts Show. And we'll see you tomorrow on the next edition of The Lance Roberts Show podcast right here at realinvestmentadvice.com. Have a great day.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.